Welcome to The Deep Dive, the show where we cut through the noise, sift through the sources, and extract the most vital insights just for you.
Glad to be here.
Today we're tackling a really fascinating question with DocuSign Inc. You know, can a company whose name literally became a verb for signing documents actually redefine itself?
Right. Become this indispensable AI-powered backbone for enterprise agreements over the next decade.
Exactly. And the market's current valuation, well, suggests a huge if, doesn't it?
It does, but there's this powerful transformation happening that makes it, well, an incredibly interesting company to look at right now.
So our mission today.
It's a comprehensive fundamental analysis of DocuSign, NASDAQ ticker DOCU. We're using data as of August 15, 2025, with a closing share price of $69.05.
And we'll be applying value investing principles to really, deconstruct their business, their management, financials, market perception, and of course, the risks.
The goal is for you to walk away with a thorough understanding of DocuSign's evolution, from that single product champion we all know to this multifaceted platform they're trying to build.
Okay, and before we really unpack all of that, just a quick heads up from us here at Stock Analytics AI. We are actually covering all of the S&P 500 stocks over the next few months. It's a big project.
Huge.
So if you like what you hear today, please do like and subscribe. Our members, it's just $4.99 a month. They get priority deep dives on specific tickers they request, plus exclusive early access to this whole S&P 500 series.
And if you just want a one-off deep dive on a company you're interested in, you can always drop us a super thanks. We appreciate the support.
Definitely. All right, let's jump into part one. The foundations, chapter 1. The digital foundation of agreements, a business analysis of DocuSign.
Okay, so at its core, DocuSign runs on that classic software as a service model, SaaS.
With a subscription model.
Exactly, which means, predictable, recurring revenue. Investors love that. In fiscal year 2025, their subscription revenue hit almost $3 billion. That was over 97% of their total revenue.
Wow.
Yeah. They do have a smaller professional services segment, but honestly, that's really just there to help onboard people and support the main subscription business. It's not a major profit driver in itself.
So for the longest time, DocuSign just meant e-signatures, right? That's still the flagship.
Oh, yeah, absolutely. It's still the world's #1 solution for electronic signing. But, and this is the crucial part, they're trying to become something much, much bigger with this IAM pivot.
IAM, Intelligent Agreement Management. Is that just fancy marketing speak, or is it a real fundamental shift in what they actually do?
No, it's definitely a fundamental shift. They launched it back in 2024. And look, this isn't just about signing anymore. It's designed as an AI-powered end-to-end platform for the entire life cycle of agreements.
The whole life cycle.
The whole thing. Think of it less like a simple tool and more like a strategic brain for managing all your contracts.
Okay, so if IAM is the brain, what are the key components? What makes it tick?
Well, at its heart, you've got DocuSign Iris. That's their own proprietary AI engine that's supposed to actually understand the content of contracts.
Understand them. How?
We'll analyze terms, find risks, that kind of thing. Then there's Navigator. Think of that like a smart, centralized library for all your agreements. Makes them searchable, analyzable, brings everything together.
Okay.
And Maestro, that's their no-code workflow automation tool. So you can build customized processes, things like identity verification, data collection, without needing to write code.
Gotcha. No code is big.
It is. And on top of that, they have their enterprise-grade contract lifecycle management, or CLM, solution. That automates everything from document generation and negotiation right through to storage and renewals.
So this sounds like a whole suite.
It is. And it's all supported by advanced identity verification partners. Think IDverse, Secure, Clear, and over 1,000 integrations with major platforms. Salesforce, Microsoft, SAP, the big ones.
So this expansion, it's offensive and defensive?
Exactly right. It's offensive because it opens up a much bigger market for them, but it's also defensive because it creates this incredibly sticky ecosystem. Makes it harder for customers to switch away.
And that stickiness, I imagine the scale helps there. You mentioned nearly 1.7 million customers, over 1 billion users in 180 countries. That's massive.
It's huge, and it's powerful. That scale means they dominate the e-signature market, over 53% share. And they've been a Gartner Magic Quadrant leader for CLM for 5 years running now.
Right.
But here's the kicker. That massive scale creates what analysts call a data moat for DocuSign Iris, their AI.
A data moat?
Yeah, think about it. Every single contract signed or managed on their platform globally potentially feeds data back to make their AI smarter. It's a self-reinforcing cycle.
So the more people use it, the better the AI gets, which attracts more users.
Precisely. It's a competitive advantage that's incredibly hard, maybe impossible, for competitors to replicate because they simply don't have access to that volume and variety of agreement data. It's not just an edge. It's like this self-fueling engine for innovation.
So it sounds like the value proposition is shifting then. It used to be just about efficiency, right? Saving time, saving paper.
Exactly. Initially, it was pure efficiency gains. 98% faster contract turnaround, 80% reduction in offer letter time, saving maybe $4 per document on average. Tangible, but maybe seen as just a utility.
But now with IAM,
Now with IAM, it's about intelligence and insight. It's about unlocking all that valuable business data that's trapped inside documents. Using AI to spot risks, optimize contract terms, even uncover revenue opportunities you might have missed.
so it elevates the product.
Absolutely. It moves it from being just a useful tool to potentially a strategic asset for a business. That's the goal, anyway.
Okay, let's shift to the broader industry then. Their traditional market, digital signatures, is still growing fast.
Oh yeah, very fast. Valued somewhere between $9.6 and $12.2 billion this year, and projected to grow at a, frankly, stunning 35% to 40% compound annual growth rate.
Wow. What's driving that?
It's a confluence of things. Ongoing digital transformation, government initiatives pushing for digitization like the U.S. 21st Century IDEA Act, the persistence of remote work, and increasing focus on cybersecurity.
And the newer market they're targeting with IAM, the CLM, and contract intelligence space.
That's also growing, though not quite as explosively. Somewhere between, say, $1.6 to $2.8 billion in 2024, with growth rates projected around 12.7% to 23.1% annually.
So there's this tension, right? They need IAM to build that long-term moat and find new growth.
But they also need to defend their core e-signature business, because that's still the bulk of the revenue and where the immediate top-line growth has been. It's a tricky balancing act.
And the competition. You mentioned Adobe earlier.
Yeah, the landscape is sort of bifurcated. At the high end, the enterprise level, you've got Adobe with DocuSign as the main rival. Though, interestingly, DocuSign often gets rated higher for service and integration capabilities.
Okay. And at the other end?
Then you have this fragmented field of smaller players. Companies like SignNow, PandaDoc, Zoho Sign, Dropbox Sign. They often compete more on price or specific niche features.
So DocuSign is fighting a war on two fronts, essentially.
You could say that. They're using IAM to compete head-to-head with Adobe in the enterprise space, while relying on their strong brand recognition and ease of use to fend off the lower-cost disruptors in the core e-signature market.
It sounds complex. Does the regulatory environment help them at all?
Massively. It's actually a significant structural advantage for them. They've spent years and a lot of money meticulously engineering their platform for global compliance. Think U.S. laws like e-sign and UEDA, Europe's IDIS regulations, industry-specific stuff like HIPAA for healthcare, 21 CFR Part 11 for life sciences.
That sounds like a nightmare to navigate.
It is. And they invest heavily in security certifications, too. ISO 27501, PCI DSS for payments, SOC2 Type 2 audits. This complex web of compliance and security built over years creates a really formidable barrier to entry. It's not easy for a startup to just replicate that level of trust and validation.
So it's not just the tech, it's the whole ecosystem of trust, as you put it. That's the highest barrier.
I think so. And you can't discount the brand strength either. The fact that DocuSign this has become a common phrase, that's incredibly powerful.
Like Google it.
Exactly. It's a cognitive shortcut, drives viral adoption, lowers their customer acquisition costs. Newsweek even named them the #1 most trustworthy software company. That's huge.
And scale gives them cost advantages too, right?
Definitely. They can amortize those substantial fixed costs like the nearly $600 million they spent on R&D last fiscal year across that massive customer base and nearly $3 billion in revenue. That lets them outspend smaller rivals on crucial things like security, compliance, and AI development.
And the network effects. Does IAM make those stronger?
It certainly aims to. You've got the basic two-sided network effect already. The more people send DocuSigns, the more valuable it is for people receiving them, and vice versa. Plus, those 400-plus pre-built integrations embed them deeply into customer workflows.
Makes it harder to rip them out?
Right. IAM is designed to amplify those switching costs even further by becoming this essential system of record for all agreements. Not just the signing part, but maybe their most unique, defensible asset at the end of the day. It's that vast proprietary data set from billions of transactions.
The fuel for the Iris AI.
Exactly. That data is exclusive fuel for DocuSign Iris. It gives them a potentially unparalleled ability to understand and automate agreements in ways competitors just can't match if they don't have the data. It really shifts the competition from just features to proprietary, data-driven insights.
Okay, let's shift gears. Let's talk about the people running the show. Chapter 2, Stewards of Capital, an evaluation of DocuSign's management.
Right. So the current CEO is Alan Thygesen. He came on board in October 2022. His background is quite impressive, actually. He previously ran Google's massive advertising business, over $100 billion, and also spent time at the Carlyle Group, a major private equity firm.
So he understands both tech scale and capital allocation.
Precisely. And he's the architect behind this big strategic pivot to IAM we've been talking about.
That seems like a strong fit for the challenge. Now, they did navigate the COVID boom pretty well operationally under the previous leadership, but there's this shadow, isn't there? This ongoing securities class action lawsuit, Weston v. DocuSign, Inc.
Yes, that was filed back in 2022, and the trial is currently set for July 2026. The core allegation is that the prior management team misled investors about how sustainable that massive pandemic demand surge really was.
How much does that weigh on things now?
Well, it definitely creates a bit of a credibility gap,
Yeah.
Even though the company promotes its trust center and talks about trust as a core value. You saw how the market reacted back in June 2025 when they lowered their billings guidance, a pretty sharp negative reaction. It shows investors are really sensitive to any perceived lack of clarity or potential overpromising.
So the current team needs to be careful.
Yeah, the mantra for Thygesen's team really has to be underpromise and overdeliver to rebuild that full market confidence. Transparency is key.
Okay, let's talk capital allocation. Where are they putting their money? It seems like R&D is a big focus.
Absolutely. They invested a hefty $588 million in R&D in fiscal 2025. That's almost 20% of their revenue, which is significant. And that investment is primarily focused on building out that AI-led IAM platform.
Are they doing much M&A acquisitions?
They're doing what I call disciplined tuck-in acquisitions. They aren't making huge company-altering mergers. Instead, they're buying smaller companies primarily for specific technology or talent that accelerates their IAM roadmap.
Like Lexion.
Exactly. Lexion for its AI agreement management tech back in May 2024 for $165 million. Before that, Seal Software in 2020 for AI contract analytics, Spring CM in 2018 for CLM capabilities. The focus seems to be acquiring tech and expertise, not just buying revenue streams. It's a smart build and buy to accelerate strategy.
Makes sense for a tech company. Now, no dividends, which is typical, but they've become really aggressive with share buybacks recently, haven't they?
Very aggressive. In fiscal 2025, they bought back nearly $700 million worth of their own stock. It's way up from about $145 million the year before.
What does that signal?
Well, first, they're generating a lot of free cash flow, over $900 million in the last 2 fiscal years, and they've returned about 75% of that to shareholders via these buybacks. Second, it strongly signals that management believes the stock is undervalued at current prices.
A vote of confidence in their own shares.
Exactly. And they doubled down in June 2025, authorizing another $1 billion for buybacks. That brings the total remaining authorization to about $1.4 billion, which is nearly 10% of their entire market cap. It clearly indicates a belief in undervaluation and a strategic shift towards profitable growth combined with returning capital to shareholders.
Okay, so management thinks the stock is cheap. How are they actually doing at generating returns on the capital they are investing? Let's talk return on invested capital, ROIC.
Yeah, ROIC is crucial. And this is actually a really positive point for DocuSign. After years of negative ROIC, which isn't uncommon for high-growth companies reinvesting everything, they seem to have hit a really important positive inflection point.
So investments are starting to pay off.
It looks that way. Different sources calculate it slightly differently, but Finbox puts their ROIC around 11% for fiscal 2025. GuruFocus has their trailing 12 months ROIC even higher at 24.1%, which is well above their estimated weighted average cost of capital, or WACC, of about 6.8%. That implies they're creating significant value.
That's a good spread.
It is. And maybe even more telling is the return on invested incremental capital, or ROIC. As of January 2025, their 3-year ROIC was an impressive 59.3%. That suggests that the recent investments they've made, likely heavily weighted towards IAM development, are proving to be highly profitable. That's a very strong signal about the potential effectiveness of the new strategy.
All right, let's dive into the numbers themselves. Chapter 3, Deconstructing the Financials, a Quantitative Analysis. So just to ground us, as of mid-August 2025, DocuSign's market cap is sitting around $13.95 billion.
Right. Now, if you look at their revenue growth over the past 5 years, it really tells the core story, the central challenge here.
It's a slowdown.
Exactly. That hyper growth during the pandemic peak, almost 50% growth in fiscal 21, 45% in fiscal 22. Incredible number.
Unsustainable, maybe, in hindsight.
Well, certainly followed by a sharp deceleration. Growth dropped to 19% in FY23, then under 10% in FY24, and just under 8% in the most recent fiscal year, FY25. That slowdown isn't just a minor dip. It's really the crux of the whole bull versus bear debate for DocuSign.
Can they reignite growth with IAM before the core e-signature market fully matures?
That's the multi-billion-dollar question. And the current valuation definitely reflects the market's skepticism about whether they can pull off that reacceleration smoothly.
What about profit margins? You mentioned the SaaS model often has good margins.
Their gross margins are genuinely elite. GAAP gross margin is over 79%, and non-GAAP is even higher at 82%. That shows strong pricing power and efficiency in delivering their service.
But operating margins tell a slightly different story.
They do. On a GAAP basis, operating margin was only 6.7% in FY25. But the non-GAAP operating margin was a much healthier 30%.
Why is a huge difference?
Stock-based compensation. About $610 million of it in FY25. While it's a non-cash expense on the income statement, it does represent real dilution for existing shareholders, so it's important not to ignore it completely.
And net profit margin. I saw a huge number for FY25.
Yeah, the reported GAAP net profit margin was almost 36%. But, and this is crucial, that number is massively inflated by a one-time $820 million tax benefit related to releasing valuation allowances on deferred tax assets.
Ah, so not sustainable profit.
Not at that level, no. If you normalize for that tax benefit, their underlying pre-tax profit margin is closer to 8.3%. So when you're thinking about valuation, you really need to adjust for that one-time item.
Okay, that makes sense. But the free cash flow generation,
Yeah.
that seems to be the real bright spot.
Absolutely explosive growth there. It's actually quadrupled in just 2 years. They went from around $215 million in FCF back in FY21 to a very impressive $920 million in FY25.
Wow. And the margin?
Free cash flow margin was nearly 31% in FY25. That kind of cash generation is, frankly, the clearest indicator of the company's underlying financial health and its capacity to invest, buy back shares, and ultimately generate intrinsic value.
So financially stable then, despite maybe inconsistent GAAP profits.
I'd say so. They don't have a long track record of consistent GAAP profitability if you normalize for things like that tax benefit. But the incredibly strong and growing free cash flow provides a much better anchor for assessing stability.
And the balance sheet.
Rock solid. Very low leverage, essentially no meaningful debt. They have over $1.1 billion in cash and investments on hand, and negligible interest expense. So yeah, no near-term solvency risk whatsoever.
I noticed their current ratio was below 1, around 0.79. Does that matter?
You know, for many companies, that might be a red flag. But for SaaS businesses like DocuSign, it can be misleading. A lot of their current liabilities are actually deferred revenue.
Money collected upfront for subscriptions.
Exactly. It's cash they've already received for services they'll deliver in the future. It's technically a liability, but it's a good liability because it represents future guaranteed revenue. So again, the strong free cash flow generation is a much better indicator of their actual liquidity than the current ratio.
Got it. Okay, let's talk valuation. How does it stack up relatively?
On a relative basis, using the trailing 12 months price-to-earnings ratio, DocuSign looks quite cheap. Its TTM/PE is around 13.2.
How does that compare?
Well, compare that to peers like Adobe at around 22, Box around 23, and the broader software industry average PE is way up there, maybe around 70 or so. Even the S&P 500 average is much higher.
So it's trading at a significant discount.
A very significant discount, yeah. Around 40% lower than key peers. Now, that discount clearly reflects the market's worries about the growth, deceleration, and the execution risk around the IAM strategy.
But for a value investor?
For a value investor, that discount could represent a double play opportunity. If DocuSign does successfully reaccelerate growth with IAM, you could potentially benefit from both rising earnings and the market awarding the stock a higher multiple closer to its peers. That's the potential upside.
Okay, so that's relative value. What about intrinsic value? Using a discounted cash flow model.
Right, the DCF is a cornerstone of value investing. Basically, you project future free cash flows and discount them back to their present value to estimate what the business is fundamentally worth.
And what does your educational model suggest for DocuSign?
Based on our analysis as of August 15, 2025, our DCF model estimates DocuSign's intrinsic value to be somewhere in the range of $65 to $95 per share.
And the share price was $69.05.
Exactly. So the current share price falls within the lower end of our estimated intrinsic value range.
What are the key assumptions driving that range?
Well, the big ones are the discount rate, which we set at 9.0%, reflecting the risk, and the forecast period of 5 years. Then, crucially, the assumptions about future free cash flow growth.
What did you assume there?
In our base case, we modeled FCF growth tapering down from 10% in year 1 to 6% by year 5. In a more optimistic bull case, we had it tapering from 15% down to 8%. We also used a terminal growth rate assumption 3.0% in the base case, 3.5% in the bull case to represent long-term growth beyond the forecast period.
And the valuation is sensitive to those growth assumptions.
Highly sensitive, especially that near-term FCF growth. The fact that the current stock price is at the low end of our range really underscores how much the market is pricing in skepticism about DocuSign's ability to hit even those moderate reacceleration targets.
Okay, that provides a good financial grounding. Let's move into part 2, market risks, chapter 4, the market's verdict, gauging sentiment.
So what does Wall Street think? The analyst consensus right now is generally cautious but constructive, mostly leaning towards hold or maybe moderate buy.
So not overly enthusiastic, but not bearish either.
Pretty much. It reflects a wait-and-see attitude regarding this big IAM transition. You see maybe 12 to 15 hold ratings, 4 to 7 buys, and notably 0 sell ratings currently.
But here's something I find interesting. Despite the prevalence of hold ratings, the average 12-month price target from these analysts is actually quite a bit higher than the current price, somewhere between, say, $89 and $91.
Right. That implies potential upside of 26% to 33%.
So how do you square that? A hold rating, but a price target suggesting a buy.
It's a contradiction that likely signals that analysts see significant potential upside if the IAM strategy really clicks and reaccelerates growth. But they're heavily weighting the execution risk in their actual rating. They see the path, but they're not convinced DocuSign will navigate it smoothly yet. The price targets reflect the potential, the ratings reflect the current uncertainty.
And the media narrative, does it reflect that same tension?
Very much so. You see positive coverage around product innovation, new AI features, IAM enhancements, strategic partnerships, that Newsweek Trustworthiness Award.
Good buzz there.
Yeah. But then the coverage around their June 2025 earnings report was decidedly negative. The focus was squarely on the lower-than-expected billings number and the reduced forward guidance. Some reports used words like sting or said the company was in the penalty box.
Ouch.
Yeah. So this dichotomy, positive on the long-term vision and tech, negative on the near-term execution and metrics, creates market volatility. But for value investors, that volatility can sometimes create opportunities if the market is overreacting to short-term news.
What about market indicators? Short interest.
Short interest is actually pretty moderate, around 3.77% of the float. That's below the average for its peer group, which is over 6%. So it doesn't suggest widespread, deeply held bearish conviction among short sellers.
And technically, moving averages.
Technically, the picture is less positive right now. The stock price is trading below both its 50-day simple moving average by about 7–10% and significantly below its 200-day moving average by 15–21%.
So negative trends short-term and long-term.
Correct. It indicates the stock is currently out of favor with the market's momentum players. But again, for contrarian investors, a stock being out of favor can sometimes signal an attractive entry point, assuming the underlying fundamentals remain sound.
Let's look inside the company. Chapter 5, ownership structure.
Okay, ownership. It's heavily dominated by institutional investors, pension funds, mutual funds, hedge funds. They hold somewhere between, say, 77% and 85% of all outstanding shares.
Yeah, who are the biggest holders?
The usual suspects, really. The top 3 are the giants: BlackRock, Vanguard, and State Street. Combined, they hold roughly 23% of the company. A lot of that is likely through passive index funds that just track the market.
What about active managers, the stock pickers?
Their activity seems pretty mixed recently. Looking at filings, you see some active funds trimming their positions while others have been adding. It reflects that broader market uncertainty we talked about. There's no clear consensus vote from the sophisticated active investors right now.
Okay, here's a point that often gets attention. Insider holdings. How much skin do executives and directors have in the game?
Relatively little, actually. Insider holdings are quite low, somewhere around 1.0% to 1.2% of the company.
And are they buying or selling?
There's been pretty consistent net selling from insiders. Now, a lot of that is often through prearranged trading plans called 10b5-1 plans, which executives use for diversification or tax planning. So selling isn't always a negative signal in itself.
Okay.
But what really stands out here is the complete absence of any open market purchases by insiders. While the company is aggressively buying back its own stock, the people running the company aren't stepping up to buy shares with their own money at these prices.
Does that temper the bullish signal from the corporate buybacks?
I think it has to, yeah. It suggests that maybe insiders, while perhaps not outright bearish, don't see the current price as a screaming bargain either. It's a signal of, let's say, tempered confidence compared to the company's capital allocation actions.
And that high institutional ownership concentration, does that matter?
It does. When a few large institutions hold significant stakes, their buying or selling decisions can have an outsized impact on the stock price, potentially increasing volatility. It also influences corporate governance dynamics.
Okay, let's pull together the potential downsides. Chapter 6, risk assessment. Maybe start with a quick SWOT analysis. Strengths, weaknesses, opportunities, threats.
Sure, strengths are pretty clear. Dominant market position, that verb status brand, massive scale and network effects, strong financials, particularly on the gross margin and free cash flow front, a fortress balance sheet, and this innovative AI-powered IAM platform they're building.
And weaknesses.
The primary weakness is that undeniable revenue growth deceleration and the heavy reliance still on the maturing e-signature market. There's also significant execution risk associated with the IAM pivot. Can they actually make it work and drive growth quickly? That lower billings guidance highlighted this risk. Shareholder dilution from stock-based comp is another weakness, as is the lack of a long history of consistent normalized GAAP profitability.
Opportunity.
Huge opportunities. The total addressable market, if you combine e-signatures and the broader agreement management space, is estimated at around $50 billion. That's massive. They have enormous cross-selling potential into their existing 1.7 million customer base. Plus, significant runway for international expansion, as only about 28% of their revenue currently comes from outside North America. And, they could potentially be an attractive acquisition target for a larger tech player someday.
And finally, threats.
Intense competition is a major one. Adobe and Microsoft are formidable rivals, and there are always nimble startups looking to disrupt. Rapid technological change, especially with generative AI, could alter the landscape quickly. Cybersecurity risks are inherent and high. Given the sensitive nature of the documents they handle, a major breach would be devastating. And of course, that ongoing Weston v. DocuSign Inc. class action lawsuit represents both financial and reputational risk.
What about broader macroeconomic factors, IT budget pressures?
Yeah, that's relevant. We're seeing high inflation, specifically in the SaaS sector, almost 5 times general market inflation recently. That's causing companies to scrutinize their software spending and rationalize their tech stacks.
So threat or opportunity for DocuSign?
It's potentially both. It's a threat if companies view DocuSign's core e-signature as discretionary and look for cheaper alternatives. But it could be an opportunity if they position the broader IAM platform as a way to consolidate multiple point solutions, achieve greater efficiency, and ultimately save money by managing agreements more intelligently. It depends on how effectively they sell that value proposition.
Any specific geopolitical risks, like those U.S. tariffs imposed in 2025?
The direct impact on a pure-play software company like DocuSign is likely negligible. They don't have significant physical supply chains affected by tariffs.
But indirect effects?
There could be second-order risks, yeah. If DocuSign's customers in sectors like manufacturing, electronics, or telecom are negatively impacted by tariffs, those customers might delay or reduce their IT spending, which could then flow through and impact DocuSign's growth. It's an indirect risk to monitor.
All right, let's bring it all together. Chapter 7. Conclusion. So, if we synthesize everything we've discussed, what's a bull case for DocuSign?
The bull case really hinges on that dominant market position, the incredibly strong, trusted brand, and the huge perceived potential of this AI-powered intelligent agreement management platform. Bulls believe DocuSign can successfully leverage its massive installed base to cross-sell IAM, re-accelerate revenue growth, and expand profit margins.
And the strong financials support that.
Absolutely. Those elite gross margins, the prodigious free cash flow generation, and that fortress balance sheet provide immense stability and the financial firepower needed to keep investing in innovation and fund those aggressive share buybacks. And bulls would point to the current valuation discount as offering an asymmetric risk-reward profile, more potential upside than downside.
Okay, and the bear case?
The bear case starts, and maybe ends, with that undeniable revenue growth deceleration. Bears are deeply skeptical that the new IAM platform can meaningfully reignite top-line growth quickly enough, especially given the intense competition from Adobe, Microsoft, and others.
The insider selling doesn't help either.
No, the pattern of insider selling, combined with the complete lack of open market buying from executives, is seen by bears as a clear sign of tempered confidence from those who know the company best. And finally, the ongoing class action lawsuit adds another layer of financial and reputational risk. For bears, DocuSign looks like a maturing company whose best, highest growth days are probably behind it.
So our educational DCF model put the intrinsic value between $65 and $95 per share, with the stock at $69 and C-Fence.
It's right there in the lower end of the range, which, again, reflects that market skepticism about re-accelerated growth being priced in.
So the concluding outlook. Where does DocuSign stand as of mid-August 2025?
Look, DocuSign is undeniably at a really interesting, maybe pivotal juncture. The current share price seems to suggest a potential margin of safety for patient, long-term investors who believe in the IAM strategy. But it also clearly acknowledges the very real risks of continued growth deceleration and execution stumbles.
So an investment today is really a bet on.
It's fundamentally a bet on CEO Alan Thiesenson and his management team's ability to successfully navigate this complex transition. Can they transform DocuSign from just an e-signature company into this broader intelligent agreement platform powerhouse? They certainly have strong assets, the brand, the scale, the cash flow, a clear vision. But the market is understandably skeptical right now and laser-focused on seeing tangible results in those short-term metrics like billings growth. Investors should probably be prepared for continued volatility as this story plays out.
That brings us to our final provocative thought for you, our listener, to consider. What does it truly mean for a company when its name becomes a verb, synonymous with one specific action, but then it needs to fundamentally redefine that very identity to thrive, maybe even survive? How will you track DocuSign's evolution if it happens from being just a signer to becoming an intelligent manager of agreements? Something to think about. And that wraps up our deep dive into DocuSign. Thank you so much for joining us today.
Always a pleasure.
Remember, if you found this valuable, please like and subscribe to Stock Analytics AI. Our $4.99 a month members get priority deep dives on tickers they choose, and as we mentioned, we're tackling the entire S&P 500 over the coming months. Members get exclusive early access to all of that.
And if you'd like a one-off deep dive like this one on a specific company, you can always support the show by dropping us a super thanks.
We really appreciate it.
And finally, the necessary disclaimer. Please remember that this analysis was generated by an AI system. It's intended for educational and informational purposes only and should absolutely not be considered financial advice.
That's right. Always conduct your own thorough research, consider your own financial situation and risk tolerance, or consult with a qualified financial advisor before making any investment decisions.